Okay, good morning guys. I think we can get started. Today we're going to talk about our initiation this morning. So this morning we issued a report on CapitaLand, and title of our report is Period of Reckoning When Efforts Bear Fruits. So I will start off with the price chart of CapitaLand, and we look at the 52-week range. So what is noticeable in this chart is that you see that at the end of 2016, after Trump won the election, the markets rallied. The real estate index actually did very well year to date. It's close to 20% up. So CapitaLand is one of the best performing developers so far this year. And our coverage, we have an accumulate rating. Target price is 419 versus the last close on Friday of 363. So first we start off with the company snapshot. We see that for CapitaLand, total assets by geography, Singapore and China remains the two biggest countries for CapitaLand. And over the years, we've seen that as part of the strategic approach by the group to diversify into more stable recurring income, instead of depending too much on the volatile year in, year out, where you get heavy ups and downs income from residential property developments. They're making a conscious effort to smoothen out the earnings and then derive more and more of the earnings from recurring income. So you see that out of all their assets, 75%, which is the whole area minus the blue bar, is actually from investment properties. So investment properties, you have like your service residences, your shopping malls, and your offices. These are the so-called stable assets in the portfolio where you actually collect rents, and the rentals are more stable than if you buy a plot of land, develop a residential project on top of it, and then your sales will be more unpredictable, so your income will be more unpredictable. So on a portfolio level, 75% of the assets are from investment properties. But that being said, for the last FY, you look at the earnings from residential sales, it still makes up about close to half of the full year. And then shopping malls and integrated developments and offices come in second. So all in, I think you are looking at a very balanced portfolio where you don't rely too heavily or too much on a single aspect of your portfolio. So our investment thesis will be as such, these four main points. We will elaborate on each one of them later on, but the four key points you have to remember is that right now CapitaLand is actually going through a phase where over the last few years they have carried out a lot of construction work on many major projects. So they are building Raffles City towers in China, especially in China. They're going in a big way. So a lot of construction work has started over the last, maybe started in the early 2010s. So now this period of time is the period of time where a lot of construction is nearing the end. So you have a lot of investment properties coming online, and once these properties start to come online, they will contribute to earnings, and then that will be the kicker in your earnings. So for instance, like you look at this year alone, there's going to be 1 million square meters of retail space that is going to be opened by CapitaLand in total. So this 1 million square meters of retail space, right, for perspective's sake, is actually about 10% of the total amount of retail space in CapitaLand's portfolio. So out of all the retail space that is opening this year, 90% is in China. So this 90% of retail space opening in China is about 14% of what they have as a whole in total retail space in China. So 14% of total is opening in one single year. And you got to remember that this total retail space is what is accumulated by CapitaLand over 20 years of history in China. So 20 years of history and in a single year this year you're getting a 13% launch. I think that's massive. So that is going to be the kicker for earnings for this year as well. So that is for the investment property side. Second point is that when we talk about residential developments in China, we hear a lot about all those cooling measures that the Chinese government is coming up with. And so it looks like a pretty dire situation for developers in there, but for CapitaLand, in fact, it's quite the opposite because they actually have a majority of launches this year which are in Chinese cities that are actually currently facing an undersupply condition. So I think if you are in such a situation where your supply is in undersupply condition, then your cooling measures, the effect may not be as extreme as people fear. These points we will go on to elaborate later on. And a few weeks ago, we actually this is okay. A few weeks ago, we saw like more intensive these measures for capital controls. But all this recent tightening in capital controls could actually lead to Chinese home buyers looking within their home country instead of looking outwards for property investments. So this actually turned out to be a good sign. Could be a good sign for a good trend for developers in China. And lastly, we see that CapitaLand, they are actually trying to evolve and take on more of this management contract roles. They have been utilizing this role for the escort unit, and right now, just late last year, they have taken on the first management contract for their retail unit as well. And by management contract, I mean that they don't actually own the mall, but they will run the mall for the mall owners, third-party mall owners, and collect a fee out of running the malls. So why this model is good? Because it is very unlike the typical property development industry, which is very capital intensive. The management contract model is actually very capital light, and it allows you to scale up your presence in a very quick way without having to put on a lot of capital outlay. So escort model was already there. Now they're going into retail, and since they started the retail model, start of last year until now, they have already taken on 3 management contracts. The latest one you can see from the news a few weeks ago. The new SingPost Center at Paya Lebar. SingPost has actually granted CapitaLand the management contract as well. So CapitaLand will be running the SingPost model, SingPost Center, the retail component for SingPost. So this model is good because it's a very scalable model. So these are the 4 key points which we will elaborate on later on. Okay, first now I'll go and talk about the first sector I want to cover, that is the Singapore residential. Since we have seen that since 2010, where the first cooling measure came on, there were many regulatory challenges for the local market. And because of this, and along with regulatory challenges, we also had structural problems within Singapore. And this both conditions actually come in, and you see that the property price index has dropped close to an 11% since the peak in 2013, the 13 consecutive quarters of price easing to where we are now. And if you look at sales volume as well, sales volume is actually down. You see that after the recovery, 2010, sales volume was actually pretty healthy. 11, 12, a little bit of cooling measures came on, but not the very binding, very harsh kind of measures. Because I think the ABSD, TDSR 2013 was what we deemed as the harshest. So 10, 11, 12, you still see pretty healthy volume until 13 came. All the harsh conditions came in, volumes dropped, and then you see that from 2012 to 2016, we are down actually about 50% in terms of volume. So just now we talked about regulatory restrictions, right? And then we say that on top of these regulatory restrictions, we are also facing structural problems in Singapore. If you guys recall the population white paper in 2013, the forecast for Singapore's population by 2030 is actually 6.9 million. And remember that period of time, there was a lot of hoo-ha just after the elections. People were complaining, just after elections, then you announce this sort of thing. But the truth of the matter is that if we forecast 6.9 million population by 2030, that implies a CAGR of 1.5% from now until 2030. So every year, an average of 1.5% increase in total population on average, if you were to really hit 6.9 by 2030. But this 1.5 actually compares with 1990s, we were actually growing at 3.1%. 2000s, we were growing much faster as well, 2.4%, the average. So if you look at this growth now, actually we are already looking at a slower growth, versus the past 2 decades, slower growth. So what this slower growth means for property sector is that you are just going to get a slower real demand for properties. Real demand as in occupiers, real demand, not investment demand, that one we cannot tell, but real demand on the ground will subside. And so for what is facing us now is that, so in the early 2010s, like 2011, 2012, we actually saw a big spike in government land sales. So that 2 years, 3 years, there was a lot of government land sales, right? So you bring forward 4 or 5 years to now. So 2011-12, you sell the land. Developers typically, you ABSD them to sell within 5 years, right? So typically, if they take 5 years to complete the building, you will have, if you had peak government land sales then, you will have peak supply of units 5 years later, which is now. So 2016, that's why we saw a peak in the supply, and correspondingly vacancy rates also went up. So but what we think is that now going forward there could be a support for property prices in that basically this can be boiled down to 3 reasons. Firstly, why there's a support from the supply point of view is that you can see that going forward the supply of private residential units is going to taper off. And this is because after the peak government land sales in 2012, right, the government land sales, the amount of land sales actually has been dropping from 2012. So correspondingly, 5 years later, you will see that the supply will start to taper off as well. So that is firstly on the supply side. Then secondly, on the one more thing about this supply side is that this tapering off of the supply in new residential units is going to be particularly even more pronounced, even more obvious in high-end properties over the next few years. In that supply of high-end properties, I mean new launches from government land sales, right, it's going to be very, very, in fact, because apart from the Martin Place bid last year, which was won by CapitaLand, before that Martin Place bid, over the past several years, there has not been a single government land sales for high-end property. So you will be able to see a period of void of supply for high-end property. So just now we talked about 3 factors supporting the prices of Singapore property prices. I talked about supply tapering. Then the second factor is from a demand point of view, right? I think right now, with all the cooling measures, ABSD and the TDSR, demand is about as low as you can get, because you look at ABSD, it's actually more punitive for foreigners, right? Foreigners versus Singaporeans, let's say. For Singaporeans, the ABSD will only kick in second property onwards. But foreigners, the first property already you are slapped with an additional 15%. So once these cooling measures turn around, there could be an uplift in demand as well. So that is from the second point of view. And the third point of view is that this actually all these things are within the control of the government. So you see that at any point they can they can reverse, or they can actually tweak the amount of intake of foreign labor if they want to, and that is provided that your local infrastructure is able to take it. Then only would it make sense, or would it be wise for you to open the floodgates to more foreigners coming in, right? They are granted that now they are saying that you should scale back on the dependence on foreign labor, but then we also see that on the other hand, they are building up a lot of infrastructure. You look at your transport network, your MRT network, your healthcare infrastructure. All these facilities have been very, very much upgraded and improved and added over the last few years. So now I think we are in a much better position in terms of the amount of people our infrastructure can take. So I think if they want to, they can possibly do it. And furthermore, if you look at land density, we're actually pretty far off from, like, the peak places. You look at Hong Kong, they have 20,000 people per square kilometers, but Singapore, we're only actually doing about 10,000. So I think if they want to, they can do it. And so these are the three factors which I think could provide support for property prices, but that is not withholding, notwithstanding a selected projects whereby the developers, they face all these extension charges. These will be special cases where there will be bargains to be grabbed, and then because of the tougher condition for developers to pass on the properties in bulk, they may actually resort more to discounts on the ground instead. So implications for CapitaLand is that the residential inventory is dwindling. Now it's only doing about 4% of total assets. We do not expect the land sales to rebound very strongly so as to allow the market to absorb the supply. And what this means is that you just, as a developer locally, you will just have lesser opportunities to bid for land. And lesser opportunities, more players, just mean that the margins will get crimped, and then your projects locally will be less and less profitable for you. Which is why we're also seeing that CapitaLand is also actively redeploying capital to other growth markets, especially in China. Also very much so in Vietnam as well, which is a very up and coming country. And for select cases for CapitaLand, we do see opportunities here and there locally, like for instance the Kampong Bugis plan by the URA to adopt a master developer approach for that district is actually to tender out that whole piece of land to a master developer who will then develop that whole plot of land as a whole. Instead of, like, the old model was that the government will decide and will specifically pinpoint this particular plot of land, what is the usage for it. But now they will adopt a broader guideline instead, and then the decision will be up to the developer to develop within the district itself. And for a project of this kind of scale, I think this if you're looking at local developers, there really isn't much other choices, and CapitaLand certainly will be one of the front runners for this kind of projects of this scale. So I think a lot of people's concern now for local developers will be what kind of charges they are subject to, that their projects could potentially be hit with the QC and ABSD charges. For CapLand, we have 3 projects that potentially could be hit with these 2 charges. For the 3 projects, KNQ9 and Marine Blue, we do not foresee much problems for these 2 projects, because for KNQ9, firstly, it is already 88% sold, and Marine Blue, firstly, you still have more than a year and a half to sell. And secondly, the unit sizes are pretty on the small side. So in that sense, the quantum for this project will be smaller as well. Versus like if you look at Victoria Park Villas, these are semi-detached houses. Every single house, you're looking at a minimum of at least 4 million Sing per unit. So not only do you have a higher quantum, your Victoria Park Villa, because it's landed, you are also not able to sell to foreigners because they cannot buy landed property in mainland Singapore. So you have a restriction of your market, you have a big quantum size, ticket size for your project. I think that one will move slower. And if you look at that project, Victoria Park Villas, ABSD for that project is due in June next year. For the 6 million, that works out to be about 5.5% of last year's operating PATMI. And then if you take 46 million, look, you want to consider it as a perspective, as a percentage of the remaining units, the total sellable area, that works out to be about 100 plus per square foot if you even out the penalty charge across the remaining NLA. You're looking at 100 plus per square foot, and that's about close to 6.6% of your average selling price so far. So for this project, if there are price cuts, we wouldn't be surprised as well. So next we'll go on to retail and office segments in Singapore. These two are pretty much talked about segments. We have covered them previously when we were talking about FCT, when we were doing our sector reports. So I'll briefly run through them again. For SG Retail, which CapitaLand has exposure both under Capital Malls Asia and CMT, you see that we actually were looking at a second consecutive year of negative net absorption of shop space, and occupancy has been trending down since 2018. We expect absorption to pick up. We expect retail sales to pick up this year as well. But even on that note, the rents could still face a bit of pressure because this year the rents renewing are those that were signed in 2014, because typical retail lease is about 3 years, and 2014 was the period of time where your rental index was at the highest. So you should still see a bit of rental pressure there. But that being said, like we've always talked about CapitaLand being a very innovative, they adopt a lot of digital strategies for the retailers, and because of all the strategies that have implemented and because of the more strategic locations of the malls, you can see that the tenant sales of the portfolio, despite the fact that they are facing a bit of pressure lately, they are still outperforming the general retail sales index as a whole. Because if you look at last 3 years, general retail sales has been negative, but at least the malls under CapitaLand, they are still able to achieve positive tenant sales and rental reversions as well. So major malls openings in the next 3 years, I think the major ones will be coming online in about 2019. 2019 will be Funan, that's under CapitaLand, and Changi at Jewel as well. Changi, that one is going to be one of the, after VivoCity, one of the biggest malls in Singapore. But all in all, if you look at the list, I don't think that is not a big worry for CapitaLand in that there's no mall that is very close to what is already what they have on the portfolio. So catalyst for this sector going forward in the near term, not a lot, but then if you stretch out a little bit further down, you see that the openings of Funan, the redevelopment of Funan and Jewel Changi Airport 2019, these two could be very big catalyst for CapitaLand as well, because like I said, Jewel is going to be one of the largest malls in Singapore, and then Funan I think is also going to be a showcase for them, in that this is going to be a mall that has a lot of technology and all the lifestyle aspects integrated into the mall. So like for instance, you're going to have a very high-tech food court with tray return robots, self-ordering kiosks. You're going to have a drive-through, click and collect drive-through pickup point, the kind of initiatives inbuilt into the mall. So all in all, I think catalyst from the retail side is on a further down perspective if you stretch it past to a 5-year perspective. But near term, we expect it to be stable. And then for offices, okay, we expect rents and occupancies to bottom only in 2018. You see a lot of articles now everywhere. Some people say it's this year bottom, some people think it's 2018. For us, we think it's 2018 because the huge supply this year is just going to be, I think it's just going to be massive. 3 million is about 3 times the historical annual net demand. So I think markets should take a little bit more time to absorb this huge supply of office space within a single year. So for leases expiring these 2 years, I think we expect, especially in 2018, rental reversions to be negative again. These are the offices that CapitaLand has under CapitaLand Commercial Trust. And why we expect negative rental reversions is also in line with our thinking and belief that rents will bottom in 2018, and that will be the time you renew leases which are signed maybe like 3 years ago. So you are renewing leases signed at a peak and re-signing them at the bottom of the cycle. So you should expect a bit of price pressure there from the renewals there. And catalyst for this sector is that the redevelopment of Golden Shoe, which probably will only come online 2021. That one will yield 1 million square feet of office space, and that is actually pretty huge because 1 million square feet is actually already 25% of what CapitaLand has under total GFA for offices now. But that one is a bit of a stretch, but it's only in 2021. So Vietnam is another up and coming market that we see CapitaLand going very, very aggressively into. Maybe we take a look at this chart first. This is the kind of number of units, residential units that have sold in that country versus the sales value of all the units that they've sold. So you look at the incremental value and incremental number of units. I think it showcases the intent of the company in that country. And then just in January this year as well, the company has also acquired a site to develop CapitaLand's first Grade A office tower in Vietnam. And they've been in there for 20 years, since 1994. This will be their first Grade A office building. So Vietnam, over the last few years, you've seen pretty impressive growth. Last year, it was one of the fastest growing economies in the world, if you exclude some of the very, very small economies. So last year, they did 6.3%. Over the past decade, they have averaged about 6%. And from now until 2020, Prime Minister has actually targeted a 6.5 to 7% growth per annum. So on that front, it looks very impressive for Vietnam. And we expect CapitaLand to continue to deploy capital into that country as they scale back on the Singapore residential side. So the next unit I'm going to talk about is the Escort, the service residence arm that CapitaLand owns. This arm, in 2016, they added 10,500 units to the whole portfolio. And so they have reached a 51,000 unit mark. And that 10,000 units they added in 2016 was the highest ever increase in history. And okay, out of 51,000 units they that is under their brand currently, we see that what is operational is only 30,000 units. So what this tells us is that when the remaining 20 units get started, get stabilized, there is going to be a big kicker in your earnings because it's a big percentage of all the, you currently have 30,000 and you have another 20,000 coming on. That kind of income is going to generate is going to be pretty huge. And just look at the the amount of units they have added in 2016. These units can generate 25 to 30 million of fee income annually once they're stabilized, and this works out to be about 20% of the units that are generated by operational units in FY16. And then for Escort, they are actually projecting a 80,000 unit target by 2020. That works out to a 16% CAGR growth for the from now until then. So another thing to note is that for out of 51,000 units that they have, about 30,000 are on management contracts, which we have mentioned before, is the kind of contract where you don't own the place, but you're actually running the service residence for a third-party owner. This kind of contract is the kind of asset, like capital outlay, like kind of model, where it allows you to scale out very fast. And so 51,000 units, 30 odd thousand is on management contract. What is in Escort REIT is about 10 plus thousand units. So you see that they have this very efficient structure, and that you are either running a third-party more third-party management contract, or your hotels are parked under the REIT. So that actually gives you it's either a very scalable platform or it's a very capital recyclable platform for CapitaLand that you can pass on the hotels to the REIT. So all in all, we've talked about these management contract models. We think it's a triple win. Triple win because of these three benefits. Firstly, because it's asset light, capital outlay light, it improves your ROE. It allows you to expand your network and your brand visibility without huge capital outlays. And then lastly, it allows you to manage quality third-party malls with an incorporated right of first refusal. So that actually paves the way for you, for CapitaLand, to do future acquisition of that mall once it's stabilized and if it's a very desirable mall. Okay, I'll pass on to Peter to talk about China.
Good morning, everyone. Peter here. Trust that you had a good weekend. So yes, just like my colleague Dong has said, China remains as a important market for CapitaLand to focus on. So just a bit more in terms of EBIT. In fact, China in 2016 has really surpassed Singapore. Now, as we shift our attention in 2017, CapitaLand China is going to launch 8,430 residential units. So this 8,430 units is equivalent to a gross development value of 12.9 billion RMB. And to put things in perspective, 12.9 billion in RMB is equivalent to around 2.4 billion Sing dollar or so, or more than that. So just this based on our forecast. I mean, if you have some time to actually do download our report, is within the it's sent out as part of our morning note. So in 2017, we project that Singapore residential sales will come in to be around 1 billion Sing dollars. When you match this against China's 2.4 billion, that is 2.4 times more. And again, this shows how much the group is valuing the development potential in China, and we'll get to that in a bit. So again, still paying attention to this chart here. between the tier 1, tier 2 and tier 3 cities, there will be around 20% or 20-30% of the launches that is coming from the tier 1 cities. So tier 1 cities remain as the powerhouses of China, and simply because of the way that the mentality of mainland Chinese. So it has always been people moving from tier 2 and tier 3 cities into the tier 1 cities to whether it's a look for work or for or for, I mean, it's mainly for work, and so the trend is going to expected to be continued, and moving forward, you can expect tier 1 cities properties to continue being to be the main driver or the highest growth there. But nonetheless, tier 2 also represents a very good opportunity because of the overflowing effects. Tier 1, at the end of the day, this is only as big as as big as opportunities can be. So there will be overflowing opportunities from tier 1 into the tier 2 cities. And more importantly is really how a developer is positioning its funds or its strategy to take advantage of this. So now, so much about the different market segments. Now look at something else here. So this is a chart that shows basically the inventory supply of the different cities in China. And for 2017, CapitaLand is launching 11. It's actually 11 developments across 11 cities in China. Apologies, there's a typo over there. So where 8 cities are actually facing at least a very minimum mild undersupply condition. So sorry, let me just do that again. So these 8 cities are facing at least some form of undersupply condition. And more importantly is that, okay, so about the other 3 cities. These other 3 cities, yes, correct, they will face some near-term price pressures because of this oversupply condition, but fret not, because these 3 cities only represent 20% of the gross development value, which really isn't too significant. More importantly, let's pay attention to where where growth can actually be found. So yes, and probably the next question that that an investor might have is that for the investors who follow China, there are cooling measures being introduced to different cities in order to, of course, to curb property price or the rapid increase in property prices that was happening in the more in particularly to the past few months. But we will get into that, like what our take off on this is. But nonetheless, just pay attention to this is that because of the undersupply condition, and most of these launches are in the cities that are undersupplied, you can expect demand to stay healthy. Okay, so I was saying, what happened recently, including the cooling measures that were being introduced by different municipal government. On top of these, there were also capital controls. Okay, so these capital controls were being intensified 2 times in the last 3 months. The first one was that the Chinese government, first thing first, they reiterate their stance of having capital controls. I mean, this is really in response to the to short the RMB, or more importantly, it was a move to it was a move to combat the devaluation of the RMB. So this came when it doesn't help when the foreign reserves has dropped by a close 25% during that period of time when there was a stock market crash, where the Chinese government has been using their foreign reserve to keep plowing out the market. Okay, so much about that. So in December, they came in to reiterate their stance that they will tighten up and intensify their capital controls. So first thing first, the first thing that they did is to probably one of the thing that sticks up like a sore thumb is actually mainland Chinese people going overseas to buy property purchases. It's probably it's probably common news by now that they're going around the world buying properties. And what the Chinese government did in December 2016 was to first stop allowing FX currency purchases at banks, and this is really to stop people from putting down payment for overseas purchases. And second thing is actually just happened 2 Fridays ago. UnionPay, which is equivalent to our nets, UnionPay has actually stopped payment of overseas property purchases. And if closer to us, to our shores, I mean, apart from just looking at the Chinese markets, so over at the developments in Iskandar, especially Forest City, uh, the main buyers of this development are actually Chinese people. So the by now they are like it's actually a big hoo-ha now that these Chinese buyers they are finding it's not because they can't afford it. It's more like they can't make payment for these properties. It becomes it becomes a tricky situation right now. Is that um, they can afford it, but they can't put down the either the down payment, or they can't carry on servicing the installment payments. So it creates a very complicated situation. But nonetheless, the thing to really take away from here is that a potential home buyer in China would definitely, I mean, the wise thing to do is actually not to buy overseas properties at this point of time, because you just don't know. First thing first is whether will your money be stuck overseas. First thing first, there's like there's just numerous uncertainties there. So it brings back to the thing that I want to talk about. So so potential home buyers, instead of looking overseas, they can actually come looking back inward. And it will be, in fact, just now when I mentioned, I mean, in the previous slide just now, I was talking about like some of these cities facing an undersupply, sorry, I mean an oversupply condition. Three cities, in fact. So the first one to actually look at is like this place called Shenyang. So Shenyang over here, which is like is highlighted in light green, which signifies that there's some form of a mild oversupply condition. Yeah, so now, I mean, if we pay attention to the chart over here, look at Shenyang. I mean, the orange line over here. It just has no signs of it being like in any under, or sorry, I mean like to be in any of the oversupply condition. And we believe that this is mainly because of the influx of overseas buyers or mainland Chinese people who are looking at overseas purchases. They're cutting back on it and bringing their own money back into their own domestic markets. And look at this, for mainland Chinese investors, how many there are really limited avenues for investors to actually look for investments outside. Within the Chinese market. Sorry. So first thing first is the stock market, but nonetheless, there's still some reminiscence about the stock crash that happened in 2014. Next is, I mean, you talk about like the general investments, like investment products from the banks and things like that. But nonetheless, the more tangible investment is still on property purchases, and is very representative if you look at the charts over here. Like for example, we talk about Xi'an and Shenyang, especially Shenyang, which has like an oversupply condition. Even if an oversupply condition, property price index has been going up, and it is indeed it suggests to us that even though there might be cooling measures, but more important is that demand is still outpacing or is overshadowing the cooling measures that that is being implemented in the different Chinese cities. Okay, so for CapitaLand, they intend to launch a development in each of these cities with a gross development value of 1.1 billion in 2017. Now, okay, but but the thing to pay attention here is that sales value is expected to decline 9% year on year. Why is it so? It's because there will be more introduction of township units. There will be launched for sale this year. So what's the difference between a typical CapitaLand China unit and a township unit? A township unit is essentially affordable housing in China, or something that is closer to in Singapore's context, or what we call a HDB flat. So a township unit is unlike a typical development. A township development can yield as much as really 24,000 units. And to put into perspective, how big is 24,000 units? Think of it. One BTO flat in Singapore roughly use around on average 500 units. 24,000 is 50 blocks of it. So this is how big a development can actually stand. And but the drawback about the township developments is that there is a large quantity of units that can be launched for sale, but they command a lower ASP because, like I said, they are actually affordable housing. So for us, we project that there will be 9,433 units around this region that will be sold in 2017, brings us to a sales value of 16.5 billion which again is a 9% year-on-year decline. But again, I would just like to bring everyone back to what I said in the previous slide about the capital controls. In fact, right now what we are seeing is that if you continue to watch Chinese news, you see that even though there are like cooling measures that are enacted that's being slowly introduced into different cities, but buyers are still coming in because there is really, again, I say, limited avenues for investment opportunities there. And in CapitaLand's context is that you can expect more units to be launched for sale if market continues to improve. I think I forgot to mention something over here is that in 2017 they're launching 8,430 units. They also have a pipeline of 40,000 units. So if you just extrapolate this 8,000 units. 8,000 units is not it's not a high number of launch for them. In fact, last year they launched 10,000. So if you just take something like 8,000, 10,000, you can roughly see that this pipeline is able to last them for at least for the next 3 or 4 years. Now, why I bring everyone back to this slide is that they have a pipeline of this amount of units, and more important is that if market continues to improve, you don't want to be caught with a situation where you don't have inventory to service the higher demand. So CapitaLand definitely has the capacity to sell more if they want to, because they have a ready inventory if they would like to tap onto the market more. Now, so much on property development. Let's shift our focus to the shopping malls in China. And shopping malls in China is actually a very, very big business for CapitaLand, simply because they own 66 shopping malls in China. And we will talk about we will put into perspective for everyone just in a few slides later. So now let's pay attention to the operating statistics of Chinese shopping malls. Is that it continues to deliver very consistent performance, and this is on top of the challenges that is being faced in the Chinese economy, as well as the ongoing restructuring of shopping malls in certain cities. And again, at this point of time, in fact, not just in this point of time, I mean like for the recent years, as well as it's actually an ongoing trend when shopping malls in China facing very low occupancy rates, and you have like a large integrated developer like Wanda, who wanted to sell away 30 of their shopping malls in the different cities across China. So why is it that CapitaLand, or what has actually driven CapitaLand or in a way, what has created successes in CapitaLand's? What's the difference between CapitaLand and the other shopping malls? I mean, look at this. For CapitaLand, tenant sales growth on average, it came in at 9.8%. I mean, between the past 3 years. Shopper traffic isn't shabby either. It's going at 3.2% on an average 3.7%. So when there are more people coming in, there's a higher percentage for sales conversion. Think about it. If nobody comes in a shopping mall, don't even talk about having any tenant sales. So more people coming in, in a way, easily translates into more sales. So for Chinese shopping malls, occupancy rate has been coming at a 94% territory, and because of the higher occupancy rate and the growing shopper traffic, that's when CapitaLand in China can actually negotiate for higher rental, which is seen in the MPI growth. So minus away 2014, when MPI growth was 19.9%, this was because of the privatization from CMA. More important is to look at the 2 recent years. It's still growing at 7.4 and 5.9%. And again, just now I mentioned something about shopping malls in China facing an occupancy problem. When you have CapitaLand China having such MPI growth, it indeed somehow buck the trend. So what is the thing that they have done that is different from them? I think this is mainly this is my sharing. This is what I've observed when I was in China. So 2 cities that I was in Chengdu, as well as at the same time I was in Chongqing. When I step into a CapitaLand mall, there is something that they've been doing correctly, because well, it's just more family centric. It's just more pleasant, in fact, to walk around a CapitaLand mall. as compared to a typical a Chinese mall. I mean, I do not want to stereotype. I might be wrong, but this is mainly based on my observation. So, what I feel that a typical Chinese mall is that is about creating it to be high end and just throwing a bunch of Prada LV shops inside, which again is not really what people really want, because the way of bringing people, or I mean, it might be interesting for someone to go in for a first time, but it's not something that that have a recurring shopper traffic, as compared to something which is family oriented. It's just more, I mean, family oriented, like a CapitaLand mall. So I mean, I don't want to go too much details, but there is really something that they have been doing very right, and we points it into CapitaLand's expertise in shopping malls. Yep. Okay. Still, right now, still on shopping malls. They are adding 8 new shopping malls, which will be open in 3 countries this year in 2017. So these 8 new shopping malls will add 1 million square meters of retail gross floor area. So this represents 10% of the group's total retail gross floor area, which is really quite a lot within 1 years of opening. So we can expect strong performance coming from Chinese I mean from the China shopping mall component, because pre-leasing of these properties already came in at as at an average of 90% or as high as 90%. So with pre-committed leases, you can expect you can expect rental to flow in as soon as the shopping malls are open. So these 6 new shopping malls, or wrong, sorry, 6 of these shopping malls out of the 8 new ones that will be launched this year, the shopping malls in China, the 6 of them, will account for more than 90% of the retail space in 2017. So right now, if you include the 17 new shopping mall assets, so we pay attention to this chart here. 8 new shopping malls will open in 2017. Another 9 they'll open in 2018 and beyond. So 9 plus 8 brings us to 17. And these 17 new shopping malls, if we include them, which will be progressively open in 2017, this consequently results in Singapore and China markets, their total retail GFA will account for more than 85% of the group's portfolio of shopping mall assets. In other words, China and Singapore will continue to be the key markets for CapitaLand. Now, okay, this is just sharing a bit more about the 6 new shopping malls, but it's not really too important of a concern here. But nonetheless, let's just quickly get through it. So these 6 new shopping malls, we can okay. So on the blended basis, MPIU on cost is stay at 7.2% between the past 3 years, FY14, FY15, and FY16. And this compares very well against MPIU of 5.5%. And this disparity is really driven by a cap rate compression. Or in other words, valuation growth of the shopping mall assets. So, but when they introduce 6 new shopping malls that will be open this year, we are expecting a temporary decline in the MPIU on cost, and this is simply because actually it's a normal thing that that developers or shopping mall operators, they will actually flush out most of the opening costs within the first 1 or 2 years of the mall's opening, and that's the reason why there might be a temporary drop in MPIU on cost. So you can expect these new shopping malls to return MPIU on cost about 2 to 3% for the next 2 years, and after that it will normalize and it will come back to I would like to think that it will come back to where it was, or 7.2%, or even better than where it was in these 2 years. So all in all, if you include these 6 new shopping malls within these next 2 years, yield and cost will come in at 6.7 to 6.9%. This is based on our estimates. Okay, we are done with shopping malls. Now we look into integrated developments. So integrated developments, for the benefit of those who may not be familiar with what it is. So integrated developments really is is a congregation of different asset types together. You can have office, you can have retail, you can have residential strata, as well as escort service residences units, all inside one development. And more importantly, within the CapitaLand's integrated developments portfolio, Raffles City is the one which is the most interesting for investors. Why is it so? It's because of the growing asset size of the Raffles City portfolio. If you look at this, if you just pay attention to this chart here, at this point of time, there are only 4 fully operating Raffles City properties in China. So progressively, from starting from this year all the way to 2019, there will be another 4 more Raffles City properties that will be operational by then. So, and what is the thing to really pay attention to is that total lettable gross floor area at this point of time is only 0.6 million. When all 8 of the Raffles City properties, when they are fully operational, it will bring total lettable gross floor area to 2 million square meters. Essentially, is something like triple the times of it. And what is to take away for investor is that, of course, one thing for sure will be that this portfolio valuation will also be boosted. At this point of time, it's around 18.9 billion. But when you add the other 4 new ones that is coming up, the 4 new ones I'm talking about is these 4 new ones that are being constructed right now. It will bring total portfolio valuation to 42.1 billion, and it will bring the amount that is attributable to CapitaLand, which is 19.4 billion. So if you look at it, if you match this against the current market cap of CapitaLand, which is 13 billion or so, 19 billion, just Raffles City alone is already more than the market cap of CapitaLand. So so what about this? Once CapitaLand has built up a sizable portfolio, it's definitely high time or ready for potential capital recycling. So what I'm referring to is that we might actually be able to witness another new REIT vehicle, and having a new REIT vehicle will be able to unlock value for shareholders, and it's definitely something again interesting to pay attention to, the Raffles City portfolio of CapitaLand. Now, it's similar for Escort, but on a smaller scale, because if you look at if you just break down all of CapitaLand's owned service residences under the 3 brands, Somerset, Citadines, and Escort, most of these are already inserted into Escort Residence Trust portfolio, or being disposed to them. So, but then again, if you drill in a bit more or look at it a bit closely, there are still a few properties that can potentially be acquired, and these are mainly the properties in China. So they own 2,925 service residence units across China, and across 16 standalone service residence units. The 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 thing over here is that there are still 6 of which are still under the CapitaLand Group's balance sheet. So meaning to say that there is opportunities for more capital recycling opportunities, and again, how it benefits a shareholder is that you'll be able to unlock value for them. Okay, and finally, we are at the fund management platform, which is most of the times overlooked by the market. So CapitaLand has a fund management platform. It consists of the 5 REITs and 15 other PE funds. AUM at this point of time, or at the end of 2016, stands at 47.9 billion Sing dollar. And if we, okay, I would not go into how I came up with my valuations, but the explanation is actually inside my report. So if you're interested, you can look at it. But right now, we value the fund management platform to be worth 37 cents in our contributes 37 cents to our RNAV estimates, and this is based on a rather conservative PE ratio of 13. So to put this into perspective, we estimate that every $1 billion increase in AUM will add 0.8 cents or 0.8 cents in Sing dollar to CapitaLand's RNAV. And we are actually very optimistic that they will be able to continue to grow this AUM because of the proven track record and its core strength in development of the different property assets. And it's attractive for investors to to actually look for a developer who is good in what they are doing. There might be many developers out there, but really, how many of these developers have a core strength in developing? I think CapitaLand is definitely one of them. Okay, so at this point of time, if we dive closer into its portfolio, there are only two land sites that's remaining in CapitaLand's China Land Bank. So it's actually fading, and this is mainly because of if people have been following the Chinese markets, they will know that the kind of suicidal land tenure prices that is happening in China. So we are encouraged, in fact, to hear that CapitaLand is not joining this, going into this direction. But in fact, they're doing something that is, I think, a wiser decision, which is to establish strategic partnerships with other people. So they jointly develop. Two things will happen here. They'll be able to tap on the land bank of these strategic partners, as well as and jointly develop the developments together. So what it means is that instead of going out to bid for expensive land, they can already tap on people's land that could be acquired, like it could be legacy land bank that has been there for a long time. So it remains much to see how things are going, but we think that this is a wise move, and we believe that they will continue to do so. And why people are interested to have what is the it's a win-win situation for both entities. I mean, for CapitaLand as well as the partners, because the partners will be able to leverage on CapitaLand's track record of its strong development expertise, especially in the integrated developments like Raffles City. Okay, I'll pass the time to Jeremy, who'll be talking about the TA on CapitaLand.
Morning guys, Jeremy speaking here. So for my part, I'll just briefly go through what CapitaLand looks like in terms of the chart. So over here on the screen, you can see this is CapitaLand on the weekly time frame chart. So on a longer time frame chart, what it's showing is currently CapitaLand is moving in an uptrend. I'll just briefly go through some narration right now of what happened previously and what we believe is going to happen moving forward. So you can see back in 2016 last year, CapitaLand has been more or less stuck in the range, moving sideways up and down without any clear trend. It's only until recently in January of this year we started to get a breakout. And sort of the catalyst in terms of a technical pattern that we sort of noticed was that the real move came after the 20-week moving average, which is the red line over there, started crossing above the blue line. That was sort of like a trigger where buyers started coming in. And you can see since then this particular crossover pattern happened. It was aligned together with this bullish breakout above the sort of 2016 range high of around 325. So since then, you can see CapitaLand has been moving in a pretty strong uptrend, breaking resistance without much effort moving forward. So that by itself signifies some sort of a strong trend in CapitaLand. And it's only until recently, at this particular point, around March this year, you can see CapitaLand tested the 2015 April-May high of around 379. I mark up the reference point over here. So that was a 379 high back in May-April period in 2015. And you can see it obviously acts as a pretty strong resistance right now. It's capping price from moving higher. So since then, you can see price has been sort of wobbling below the 379 resistance area. And we believe the near term, what should happen in terms of the price chart, we believe that CapitaLand should enter some sort of a prolonged correction moving forward. And in terms of where the correction will end, probably looking at some support area, we are looking for a rebound of the 352 support area, as well as the 348 level, which was formed back in around September 2014 period. So in terms of the trajectory moving forward, we believe CapitaLand, like I said, is going to enter into some sort of correction, continue this correction move, probably down to this area, and then after which some points to take note will be to look out for bullish price action. Once we see some bullish price action start appearing within the market, I think that should be a good signal that CapitaLand is ready to reposition back itself into the uptrend and probably rebound on this support area and retest this 379 critical resistance area again. So all in all, long-term uptrend remains intact. Short-term move probably will see some sort of correction. So in terms of the uptrend, we believe that the uptrend will stay intact so long as this 340 level holds, which then coincides with the 20-week moving average as well. So keep a lookout for when this correction will end by watching out for bullish price action starting to appear in the market. And yeah, with that, I'll pass the rest of the time back to Peter.
Hi everyone, Peter again. So finally we came to our valuations. Okay, first thing first is we initiate coverage with an accumulate rating. So target price is $4.19, and this is based on a gross asset value per share of 679. And when we take away the net debt as well as the committed capex for it. So adhering to our house view, we take a 20% discount to our RNAV projections, and that's how we came about with our fair value or target price of $4.19. So 20% discount to RNAV is consistent to the other developers that we have cut under coverage, such as city developments. So with that, we come to the end of our presentation. Feel free to ask any questions if you may have. Thank you. Hi everyone. I got a question about why do we have a 20% discount to RNAV. So I'm sorry. I think first thing first I must apologize. I could have skipped this slide by accident. But to answer the first question is that okay, on historical basis, price to net asset value has been at the 0.8 territory, and that's the reason why we take 20%. But not to worry. But if the property or if the markets continue to increase, you can be sure that we will reduce the discount to RNAV. So having a discount is actually good for investors because we stay conservative, and staying conservative maintains the margin of safety that the investors should be looking out for.
Hi, good morning. Teo Hong here again. Okay, we have a question on the retail segment. So we have a client asking about e-commerce, and then so he's saying that e-commerce is a threat to retail malls. So is there a risk of buying CapitaLand? So I think we have to understand that okay now it is not a doubt anymore that e-commerce is posing a very serious threat to commerce, yeah, to traditional brick and mortar commerce. But right now, what a lot of these malls are doing is that they're trying to create this. They're trying to better your shopping experience. So I think what we have to see is the kind of strategies that Capital Land has been doing to help retailers is about is about a collaboration. If your retailers can do well, your malls will do well. So Capital Land, as I said, they actually do a lot of digital strategies, and they are very forward-looking, very innovative developer. You look at like for instance, last year they launched this food to go program at two of their malls, Raffles City included. So what they did for the office workers in that malls was that the office workers can actually order online from the F&B outlets, because you know not all F&B outlets have this online presence where you can go and buy online, right? So what the mall operator has done is that they actually help or tie up with F&B operators to offer sales online. So office workers in that building, where for instance we are at Raffles City also, so we can actually click an order online and go and collect when at a particular selected time. So these are the kind of initiatives that the mall operator has done to help retailers. And then you think of like we mentioned about previously, we also mentioned about it, like for instance they have done like the centralized dishwashing as well. It's about improving revenue for them. Also it's about rationalizing their costs. So they have this pilot um, dishwashing program, centralized dishwashing. This is a collaboration with Spring Singapore. So they set up the facility to allow F&B tenants to sign up for the service, get their dishes washed on site at a centralized place. So this actually achieves two effects. Firstly, you don't have to wash your dishes on site in your restaurant. So you actually can make better use of your space in the restaurant. That's number one. And secondly, you also save on labor. So you're making better productivity use of your shop space and your labor. And then yeah, so you look at Capital Land's malls, you look at CMT's, all the tenant sales. Look at the tenant sales. We had a chart on that. Tenant sales, you can see that because of the way CapitaLand has operated their malls, and then because of the central locations of their malls also, when retail sales get bad, usually CapitaLand will be more insulated because of these reasons. And then you look at the expertise in managing malls. I think it's also demonstrated when you saw that SingPost they actually appointed CapitaLand to manage the malls. So all in all, it's about creating a better experience both for your customers and for your tenants as well. So I think in a way, um, we still see pressure, but then it's going to be pretty stable for CapitaLand malls, because a lot of them are also located at the suburban areas where you have more necessity spending kind of tenants.
Hi, Peter here. So, I'd like to take two questions together. So the first question is, um, uh, sorry, let me just get to the question. Okay, so someone actually asked like if you look at the peer comparison table, based on the peer comparison here, is FCL, sorry, I mean Fraser Center Point Limited, is a better buy compared to CapitaLand? So yes, I mean if you look at the I mean if you just purely look at the ROE, ROA figures as well as the dividend yield and a cheaper book value, you on hindsight, yes, indeed, it does look good based on statistical return. But again, I'd like to remind everyone that when it comes to investments, it's really we shouldn't just consider just on one aspect. I think it's a marriage between the fundamental as well as the technical portion. So hear me on this. Well, I'm not discrediting anything on him. This is really about being objective here. So for yes, correct. I mean, they may return a high ROE, ROA as well as a dividend yield, but look at it from this point of view. At the same time, it also has a higher gearing at 41.2%. We compare these to CapitaLand, which is at 33.9% or the 34%. The higher gearing really, I think, is really not it's not the most attractive thing to do here when we always hear about the interest rate hike. So higher debt will for sure will have a higher impact from a potential I mean like from a, not a potential, I mean from an eventual interest rate hike. So henceforth, and this is just based on statistical. But more importantly is that I also like to remind everyone that we don't have coverage on Fraser Centrepoint Limited. But the way these two companies are playing out or panning out, they are very different. In fact, dynamics are very different. So Fraser Centrepoint has a heavy focus in Australia, while CapitaLand doesn't have it. And we believe that really again we are reminding everyone that CapitaLand is about being positioning right in the to take advantage of the seeds that they have actually planted years ago. So I'm talking about China, and this is really a point of time when they are actually reaping the fruits of their labor. I'm talking about just now when we talk about the integrated developments that are under construction. When four of these Raffles City properties, when they are finished erected or when they are fully operational, it will increase its portfolio, the amount, the portfolio valuation to be even more than the market capitalization of CapitaLand right now. So I know that I went from many angles, but really in summary over here is that we got to really look at things in perspective and not just look at statistical. And the reason why I put it here is really just to give a snapshot to everyone on how the companies actually compare. Hi, I got a question, and thanks for the question about when someone mentioned about having more property does not mean higher growth. I cannot agree more with you. In fact, you are absolutely right to say that. But I think you are mainly referring to the Chinese properties or the okay. Let's look at it from this point of view. Okay. I mean, first thing first is that as I said just now, there are 8 new shopping malls that will be open in 3 countries in 2017. So 6 of these, right, comes from China, and I get. Just give me a moment. Okay, sorry, I was I was just looking through my slides. So okay, on the shopping malls portion, yes, you're right. I cannot agree more about having more properties doesn't translate into a tangible growth or a good returns for the shareholders. But uh, we start looking at different asset classes. So for shopping malls, the 6 new ones that is coming online, uh, for the 6 new ones, there's already a pre-committed lease of 90%. So meaning to say that when it opens, it's ready functioning and it's ready to bring in rental income. So this is just a summary for shopping malls. And the next thing to consider is that for development properties, I think the thing that I continue to emphasize is that you may have more launches, but again, it really depends on whether the company is positioned right. So for CapitaLand, 8 of these cities, or wrong. I mean, out of the 11 launches that they will have in the 11 launches that will go across 11 cities in China, 8 of these cities are currently facing at least a mild undersupply condition. So these 8 cities is really 80% of the gross development value. And the market dynamics is definitely in favor of CapitaLand. I mean, the last thing that a developer want is to actually launch more units in an oversupply condition or in a weak market. And this is in fact what is really happening in Singapore, especially during the time of 2013, 2014, and such. So I hope I hope I answered your question on that.
Hi. Okay, there's a question on this chart, this price to NAV chart. So one of our customers is asking about what is the RNAV. Okay, so we saw that the price for CapitaLand actually moved up close to a one times price to book on two occasions in the last 7 years. First time you saw it was in 2010. Second time you saw it was at the end of 2012. So the question is, what was the RNAV at these 2 points in time, right? Because if there is no change in RNAV, then RNAV is not a key concern for the price going higher. So I think, like we mentioned before, that for developers, it's actually a capital recycling kind of business. You need to be able to recycle your capital and recycle and make a decent margin out of whatever you have developed, and at the same time maintain a certain kind of stability in your earnings, right? So for the developers, it's a function of two things. You need the prices to be decent, the prices of the units you're trying to sell to be decent. And secondly, at the same time where prices are decent, you also need to have volume. So either one is missing, you are missing one ingredient for the kind of growth that you need. So you need to sell units and you also need the price to be decent, right? So like we showed just now in the chart, in that 2 years, so it's 2010 and 2012, right? In that 2 years, I believe that we saw very, very buoyant demand on the ground. Uh, Sales transactions were very high. That was after GFC. Recovery went on. Even after a few cooling measures, the transactions were still very healthy. So I believe at that point in time, sentiment was very good. Plus, you had the transactions and the volume to recycle capital, which is why, as a whole, the sentiment towards developers were pretty buoyant, and that was why the discount to book was narrowing. And at the end of the day, when we look at price as a function of volume and stock price as a function of volume sold and as a function of price of your property units, you're actually looking at the ability for developer to recycle capital and to make earnings as well. So if you talk about volume of units sold now, even though we mentioned that in Singapore it's getting harder to generate the kind of volume to sell on the ground, but don't forget CapitaLand is very heavy, very intensive in China, and China sales, like we covered earlier on, is still pretty buoyant, still pretty bullish. A lot of cities they are launching in is still facing a mild undersupply situation. So that's one. So, and then to add on to the fact that because you need kickers to earnings, right? That's why when volume is high, your stock price tends to follow. So that is also as a result of a function where you had high volume means you have a kicker to your earnings. And what we are facing now is that we are facing a lot of pretty healthy kickers to our earnings, in that the 1 million square meters of retail malls coming online, that is a good kicker to earnings as well. The Escort side, the operational units is only 30,000 out of 50,000. So there's 20,000 which are yet to come online as well. And then there's the management contract as well. So all in all, not just are you having still healthy residential sales in China, you have a few kickers to your earnings at the side as well, from your retail side, from your service residential side. So all in all, we believe that those could potentially be catalysts for the stock price. Okay. Question is what does secondary sales mean? Secondary sale in this chart just mean that it's not a sale done directly by the developer. It's either a resale or a sub-sale. Okay, guys, if there are no more questions, I think we can come to the end of our webinar today. We look forward to seeing you guys again next week. Thank you.